thanks everyone for joining today. Those of you who are joining live and also who are watching the recording. Again, we always appreciate your help. Sort of around this time of year, as we're coming up to June 30, especially for our Australian clients and friends, we found that it's really good to go through one of these webinars just to have a look at sort of year-end optimisation. What's different about this year from previous years where we've done this is through a bit of input from John, one of the panelists today. There's actually a piece of work that's looking to be done, which is future looking around ESG as well. Normally, you wouldn't think that year-end reporting and ESG would fit nicely together, but I think from what you'll see in today's webinar is actually there is a lot of crossover with regards to the reporting at the moment for your year-end, but also being prepared for what is coming in the new year and what's going to be mandatory within a year. So that's why this webinar is around year-end optimisation and new year preparation, as opposed to just the first part. So yeah, basically today, what you're going to find is this is what we're going to talk about. So auditors, what they're looking at and pinpointing at this reporting period is probably one of the key things that a lot of you are going to be quite keen to see, and we'll get John's comments as well. Areas from the IFRS 16 process and compliance, certainly taking from what Quadrant's seen in the market, some of the process inefficiencies, common areas that people need to look at now that we're sort of 4 years down the track since the implementation of the standard. You know, what good processes should look like. There's a lot of processes that are in place at the moment just because they are. And that's where we're going to do the pivot into the ESG reporting, and sort of identifying what stakeholders want, what you need to be prepared for, and the general status of it. You know, what's happening. There's so many frameworks that have been talked about. We talked about the alphabet soup with regards to ESG, what you need to look out for and when it's coming. And then probably a key thing at the moment, which is certainly something the regulators are looking at, is greenwashing. So we'll get a bit of an overview around that, what it is, what to do to avoid being caught in that trap. So quite a bit to get across today. Helping me out, John Askham, who's partner at Grant Thornton. You'll see him down there, depending on what your screen setup's like. He's in the CFO Advisory side, has a lot to do with the different IFRS standards across the time, but has also got a personal and professional interest in the ESG space and growing that business within Grant Thornton in Australia. To my left, learned colleague, Stefan Ego, who's the CFO here at Quadrant. He is in a unique position where both our leasing side of our business, the CFO side being a chartered accountant, but also seeing the system side with regards to a SaaS product being our LOIS system. So many hats he wears. And then finally myself, Damon Kennedy, I'm the client success director for the LOIS program that we've got here. So you know, we see a lot of clients with 100 clients across Australia and New Zealand, soon to be Africa and Japan as well. We do have a really broad range of clients, a lot of ASX, NZX, 150 clients, as well as government multinational clients. So it gives us a really good feel of what's going on in the market at the moment. And we're talking to yourselves, you know, being the key finance players at the forefront of reporting. So we'll start off today. Pretty much since a year ago, we're talking about season 1 and 2 of these webinars. A year ago, we were looking at low interest rates. Everyone was high-fiving and house prices and that going up. But there's been a massive change. That change actually flows down to your organisation and what they really need to do, because what they were looking at or what you were looking at 12 months ago has probably changed quite dramatically up until now, and certainly will change in the coming months with the pending recessions and that economists and that are talking about. Stefan, you first. What do you reckon is the most important thing that's happened?
Well, I think obviously with the world changing so much with high interest rates, that capital management piece for all entities has become really, really important. So we were down at 3s and 4%. We're now up at 7s and 8s for most businesses. Makes a massive difference to manage your capital properly, your working capital, your debtors, and that links in really nicely to leasing. Often people lease assets, either like property because they kind of have to, but also there's a leasing reason to kind of spread your cost of capital and an efficient means of doing it. So it's quite topical for today's stuff that the world's changed. We're seeing more and more people move to leasing. What we're trying to get across is that efficiency of leasing and doing it properly as well.
Cool. What about you, J.A.?
I remind everybody that, yeah, but thing and not reporting hasn't way. So you probably bit of a sigh of relief as we go through the big standard change or like a few years with leases and financial instruments, and we are seeing more auditors for turn lease robust, better documentation. They are under pressures and from later some more detail about that. I think staff shortages are still an issue. Financial, we're helping a lot of caravan to get through, and then also the ESG is obviously and finance under more pressure.
I think
side of things.
Just to jump in on you there, J.A., I think the other issue that we're all finding at the moment is technical issues and IT issues. Just that you're breaking up every probably other word. So
apologies. Is that any better?
Yeah, it seems a little bit better. So sorry to drop in on you there, but if you wouldn't mind just sort of starting over again.
Okay. Just saying, I wanted to remind everybody that financial reporting hasn't gone away, and there aren't any changes in account. It's sort of there's expectation internal documents and systems that are more
still got those issues. I might just cut you in there. We'll go back to John around that. John's talking about some of those financial reporting issues and the like. What's your take on that?
Yeah, well, I think in any given year, as financial people, there's reporting that needs to be sorted out, and whenever there's any change. 2 years ago it was COVID. This year it's higher interest rates. We'll talk a bit more about the ESG impact, but obviously you've got a lot of judgments and assessments that come in with reporting that need to be looked at. So there's always a range of issues, and they're always changing, and that's where kind of what the auditors are looking at is kind of important as well.
Cool. John, I'll come to you now.
That's my microphone now. Is that any better, guys?
Yeah, that sounds a lot better. If we move on from what you were talking about there, and you can expand on what you were mentioning before, we're talking about what the audit focus is for this year's reporting period. I found it quite interesting that you broke this up into two parts, one being the regulator side and then the other being the organisational side. Why is that?
Yeah, so the regulator piece is interesting, and one of the things I was talking about before was auditors themselves are under pressure from regulators. They're inspected by corporate regulators, and they have their own audit quality findings. So some of that pressure is obviously filtering onto their clients. Auditors are putting pressure on their clients to improve documentation, make sure complex accounting positions are documented properly, and that there's robust systems for reporting on that. And so, I mean, we help clients often that are audited by other firms where auditors can't help them because of independence reasons, but they're saying you need to have a good paper on file for this complex lease, or you need to, you've entered into this complex convertible note, you need some proper documentation for us to be able to audit it properly. So we're seeing our clients under pressure from sort of not directly because of external reporting changes that affect them, but that affect their own auditors. On the organizational side of things, we've talked about the macroeconomic changes and sort of uncertainties in the world. Auditors generally are pressing clients to make better disclosures around that, and particularly around the impact of what those uncertainties might be, particularly with climate change. So we'll come on to some of the ESG reporting considerations, but there is a requirement to do some various scenario analyses and talk about the financial impact of climate change situations and other uncertainties. So I think a mix of sort of internal and external pressure is why we sort of divided that. We've got a point there on, I said before that there aren't any big new accounting standards coming, but spoiler alert, there is one on insurance, which I don't know if that will affect too many of the audience. It's obviously going to have the most significant impact for insurance companies. But we do sometimes see a slight scoping issue if you've got certain contracts that you might not think of as insurance contracts, but you're actually guaranteeing some condition of an asset, for example, or there's some non-financial risk that can push you into that standard. The other piece, and I know this is sort of a big focus today, is around ongoing complexities to do with IFRS 16. So it's obviously a few years down the track in terms of implementing that new standard, but we're still seeing some complexities around lease modifications, and in particular, good systems. So auditors have, I think, generally got the view that Excel might have got you this far in terms of tracking the handful of leases that you've got. But because of the number of manual workarounds and manual adjustments, there really is a bit of pressure to now invest in a decent system if you haven't already.
Before I ask Stefan about that key point, you mentioned before about some of the sort of potential double handling from a auditor requiring different position papers from somebody external and how you have held organisations. Do you want to give us sort of an example about that and the benefits? Because I mean, if you look at it from an organisational perspective, they're going, okay, then that potentially is another cost. That's hard to get sign off in the position we are at the moment with everyone going, okay, then let's sort of hunker down a bit around spending. How would you sort of answer that?
Yeah, so look, I completely appreciate it. Might not seem that intuitive to engage another service provider on top of your auditor to help you with a complex transaction, but we've had situations where particularly listed companies, Big Four audited, that have done something really complex, like a complex series of financing transactions or a complicated acquisition. And the auditor's saying, look, we'd love to help you, but we're under our own sort of independence rules. We can't tell you how to account for this transaction. So we encourage you to go to somebody else. And that's where we come in sort of as an extra pair of arms and legs to help the client through that. So not only, I guess, making the audit smoother and reducing the effort needed from the other firm, but making sure the client's got a proper idea of the complexity so that they can take that forward into other transactions. They've got a paper that they can show their board and other stakeholders that they know what they're doing in future. So we see it as a win-win, really.
Yeah, that makes sense. Now, Stefan, going into the piece around the IFRS 16 complexities, we've talked about it for 4 years now. What sort of changed?
Well, I think obviously it's a period of time of the modifications that people need to get used to and working out how they work, but probably there's also actually been some changes in the standard itself. So the IASB obviously brought out COVID accounting with concessions and the like, and there's also some impacts around rent impairments. Sale and leasebacks was another area that got taken up with changes. And again, I guess these people that are using spreadsheets or the like, they're kind of behind the 8 ball on a lot of these things because they have to kind of recalculate and redo that kind of information. So it's really, again, whenever these things changes occur on a lease, there's generally quite a technical piece involved there.
Do you also think, and this sort of feeds into the next slide, that 4 years on, there's probably a chance in most organisations, and let's be frank, we're finding this with a lot of our clients, haven't actually done any review on what they did back in the day. So 2019, when the change came in place, people did something, there was no precedent. So you didn't know, you had a blank sheet of paper and you had to work something out. Have they gone back and looked at that? What are the, has it been refined? What are people missing at the moment that this is an opportunity for them to go back and have a look at?
Well, I guess like John said, that back in 2019, you did position papers, you had processes, you had policies around how you thought it would work. People also went out and got systems that they thought would do everything that they needed. I think probably most entities have been surprised by the level of work that's been involved with IFRS 16, especially if they're using spreadsheets and the like, because the changes need to be updated and maintained. We've had a period of COVID, obviously staff turnover. You get turnover if the system is not robust and well processed, and you're going to have problems. So I think a lot of clients are finding that's a problem. We've seen also a move in the market where quite often the system selection might be led by, say, property or the like, perfectly good for property, not so good for accounting, and then suddenly you get to start getting cracks in the process, and suddenly people are spending a lot of time on something that should be relatively trivial, and then when you get staff turnover, it gets exacerbated. So, I mean, the real common area, risk areas around those modifications, because they're technically hard, but also to John's point, the positioning around IBR rates, policy and the like has probably not really been reviewed. And we've seen auditors really drilling in on IBR rates in particular, but also policy. So policies around rent holdovers and all that kind of things, because over time things do get clarified.
So John, on that piece around the policy and positioning papers, which goes back to your point earlier, what's your sort of view if you distill it down to actually IFRS 16 and what clients should be looking at?
So I completely echo everything Stefan said about modifications in particular. Are very complex. There's a whole set of rules around whether something is a modification, it's not, how it should be measured, how it should be remeasured. So I think the audit trail of what's actually happened since the standard was implemented is really important to maintain, particularly if the business has been through changes. So I've worked with clients that have been through acquisitions and had to reset a whole load of leases and get new IBR rates and then have those leases valued. So just purely because of the passage of time, a lot would have changed in the business, as well as sort of grappling with complex requirements. So I think, as always, documentation and audit trails are sort of the key things to have.
Cool. Now, the last point at the bottom there, we're talking about the ever-changing macroeconomic environment. We know as a leasing business, you're somewhat insulated because there is a flight to leasing in these sorts of times. Sort of want to expand on what we're seeing from that side of the business as opposed to the actual policy and process side?
Yeah, well, earlier we kind of mentioned property. People will always lease property because you're not going to go out and spend tens of millions off your balance sheet for a property. So leasing makes sense. I think what we're seeing with the rise of as a service and leasing, different product groups are becoming more and more popular. IT is a classic one. Simply with working from home, staff satisfaction, that having a modern, efficient fleet, more and more entities are going for leasing around that area. It's very cost effective. Your cost of capital is low. You can have a refresh of fleets. Lots of other reasons for it. So we're seeing a lot more in that space. And then there's the traditional leased assets of like mobile equipment and fleet, which have always been leased. It's fully maintained. You're pushing the risk off to the lessor. That's by far the biggest volume we see in our clients. But I think there's a realization that leasing has got a much broader part to play with different asset classes, especially as companies become more aware of being, a better corporate citizen, which kind of leads us back to that ESG piece.
Is it also fair to say, given what's happened in the banking world or the funding world, probably a more broader way to put it, the diversification of funding as well is actually quite important now, whereas 12 months ago we talked about it, low interest rates, there's tons of money in the ecosphere, that there's tightened quite dramatically over the time. So the flight to diversification is actually, helped by these sorts of products. Yeah,
I think you only have to look at how much money the banks make to see that they're in a bit of a purple patch at the moment.
Hi to all our banking clients out there.
Having said that, as times get tougher economically, I mean, New Zealand is just narrowly missed a recession. Aussie's kind of close as well. Invariably, that crunch will come into the capital markets, and funding is harder to get. So if you can diversify your funding base, obviously that's really good. And then if you've got the proper competent lessors on your side, your cost of funds will naturally go down with the investment.
And as we were talking about before, with that and the flight to that type of cash flow product, again, measurement and reporting, which is a common theme that we'll be talking about today, just becomes that much more important. Now, John, as we get into this one, we're looking at inefficiencies. One thing that we've seen probably in the last 6 to 12 months from clients is that everybody's 110% utilised. It's amazing when we're talking with clients and saying, look, we can actually help your process flow, but you need to invest this amount of resource to do it, and you'll get back literally days on end. With staff turnover, you've got COVID, there's work-life balances. And then the next step is you've actually got organisations going, well, notwithstanding you're 100% utilised, we're actually going to reduce the workforce, or you can't actually even get staff if they wanted to expand. How are you seeing it from your side?
Yeah, it's a very common story. So we're often hearing that people are too busy to focus on strategic initiatives or invest in proper data analytics or business intelligence. And when you dig into it, it's actually because of inefficient systems or old processes causing those people to be busy, chewing up all of their time to not be able to focus on more strategic things. So often we're engaged to just map out processes, take it right back to basics, work out who reports to who, where does all the information flow, and produce a really simple visual representation or a risk and control matrix of current process. And often just by doing that, you can find these inefficiencies, you can look for opportunities for improvements, for automation, for all kinds of things. And people often at that point get a bit nervous or a bit scared when you start talking about automation. People think robots are coming to take our jobs and AI is taking over, but it's not about that. It's actually about freeing people up to have better use of their time, to take them away from the routine, mundane things that are chewing up their time. So we've helped plenty of clients identify really simple bits of routine processes that can be automated, and that frees them up to do more strategic things, to partner with the business. So yeah, it's a pretty common story.
I think you hit the nail on the head here about that fear factor, where organisations shouldn't be scared of actually investing that time and resource. We're seeing it from a system perspective at the moment, because people haven't changed in the last 4 years. They've got or went through a hell of a time to implement for IFRS 16. They actually get a bit of Stockholm syndrome. So, they're trapped with it, and the last thing they think that they want to do is to go through that process again. I mean, Stefan, things have changed since like the implementation. If we're looking at IFRS 16 specifically, how does that look at the moment?
Well, I think once upon a time, because it was new and different and no one had done it before, it was quite a drawn out process and could be months. Nowadays, with the rise of your kind of APIs and the like, that loading of data from other systems is really easy. It can be done really, really quickly. So from once upon a time, it being a really complex, hard project has become relatively straightforward, because it's often just transforming data from spreadsheets to another. And then basically, by investing that time up front and getting it into a purpose-built system, you lose a lot of that inefficiency. So to John's point, instead of wasting time on spreadsheets and really reconciling spreadsheets, the system can do that for you and automate that whole process. So I think finding those little gains, which can actually be quite big, is really about getting that process sorted and having a system that can handle it as well.
John, the other piece we talked about earlier was around communications and communication lines. So as part of that process flow, can you sort of expand on that about the comms piece?
Yeah, so look, we've worked with some organizations where, finance, IT, property, procurement, they don't speak to each other, or they don't share the right information, or they all have different languages. It happens particularly with IT and finance. You often talking about the same assets in different ways, and it's really hard to just get the granular information that you need to properly, robustly report on things. And so that's certainly an issue. And I think it's really important to just, again, stand back and just simply map out where everything goes, who needs what is that spreadsheet used for. We've seen cases of, one team reporting to another team and the information doesn't go anywhere. It's not needed. So you don't need that part of the process. And so, yeah, really encourage, obviously, sort of sharing, particularly with large sort of decentralized organizations. There's some politics involved as well in sharing some of that information. But I think just, working out who needs what, where the risks are, is a really sort of simple first step to take.
I mean, organizational politics could be a whole webinar in itself if we wanted to go down that rabbit hole. If we look at what a good process should include, literally, if you put your sort of, say, auditor's cap on, John, what are you looking for, and what advice would you give to the people watching this webinar today, where they should start, and to get those easy wins and early wins, which can then flow on to getting some of those bigger, probably more intense processes sorted?
Yeah, so particularly when it comes to leasing and IFRS 16, I think I really think the use of a system is something that auditors are really going to encourage. As we talked about Excel, that may have sort of got you through the transition, or may have got you over the first couple of years of reporting. But I think auditors now are seeing so many manual adjustments or lease schedules that have just completely deviated from what's actually being posted, that there's a real encouragement to have a system that is fit for purpose. So yes, it has a nice front end that everybody can use, but it has a robust calculation engine behind it. And then I think a strong policy overlay. So yes, you've got the system, but you've been through the proper work to document all of your judgments. You've set your thresholds. You've worked through policies on term extensions and things like that. So I think just some proper system documentation and the ability to churn reports easily.
I think one thing we haven't sort of drilled down around that system part previously is around the manual overrides that seem to be happening at the moment across a lot of organisations we're coming across. Let's sort of talk to that a bit more.
Yeah, well, so I think I guess as an occupation, accountants in general have grown up with Excel, and there's a fallback to Excel in most circumstances. So if something gets a bit hard, we'll chuck it in Excel and have another process in Excel. So we even see it with people with systems that there'll be something that's a bit harder or not understood, and it will go into Excel. Of course, when you start doing that, that automation disappears, that kind of robustness of system disappears, and it generally will create more work. So the, I guess, more organized or more forward-thinking clients are really not doing that, and what they're actually trying to do is get the data out in a format to provide the data to the correct people so that proper decisions can be made. So Excel has a place for sure. Input and output via Excel is really good, but storage is very poor. So what we're seeing is a move. Everyone talked about getting ROI from IFRS 16. It's been, what, 3 years now, and it's probably fair to say most people haven't achieved that goal, but we are starting to see people that are getting that kind of synergies with the data flow and sharing it across the business. They can get the ROI. So if it's all in finance, you're never going to get that ROI, but once you start hooking up those teams of IT, procurement, property, and finance with different forms of the same data, that's where you start to see it really working.
Which gets back to John's point before about communication as much as anything, creating those lines and processes. The final point here, I mean, it's pretty self-explanatory. Review, review, review. John, you want to expand on why it's so important to do this?
Yeah, I think, look, I think if you don't regularly review processes, you just run the risk of things going wrong. So we've talked about the amount of time that's elapsed between initially setting up systems and processes and now. We just can't sort of recommend strongly enough that you just keep reviewing those processes. So you do have your internal documentation about process flows and who's in charge of what, staff turnover, people leave, people don't know how to use a system, people lose information. And again, finding the opportunities to improve the process as you do it. So we've really sort of pivoted away from long narrative descriptions of processes, and just simple visual flow charts really show where things are going wrong or where there are risks.
I mean, we talk about it, you don't know what you don't know. How are you sort of seeing that bit about reviewing?
Well, I think it depends what stage, I guess, clients are in their journey. I think most of our clients on the lowest side of things are lucky that a lot of the calculation and reconciliation is done automatically in the system, so they can step to that review process. Whereas obviously if you've got certain systems or spreadsheets, it's actually reconcile, 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 review. So there's a lot of steps in there. So you just don't get that time to look at it properly, because you just want to make sure that your actual basic debit and credit is right. So that wastes a lot of time. And then therefore you're not going to be adding much value. You're just going to simply be doing a compliance task and making sure you've largely got it right.
It's self-fulfilling utilization,
Exactly.
isn't it?
Yeah.
Go now, we've got a bit of a poll just around that. So have you reviewed your IFRS 16 process or policy since adoption? Yes, no, sort of. Just launch this. Okay, so that should come up on your screen now. If you can help us out with this poll. Quite interesting when you see the results of these slides coming up, and a few cheeky questions and that coming through around it. And because it's anonymous, people don't know, or won't, aren't afraid to actually tell the truth which is sometimes not the case when you go face to face. Okay, so if we're having a look at that, I'll share the results. I mean, a third of people are looking at it. You're looking at it almost a third. So, I mean, again, there's 60% of people that haven't actually gone back and looked at that. What we're seeing at the moment, we had a classic example recently where they were taking 8 days to do their IFRS 16 review each month. And with a couple of tweaks around it, we can actually save 7 of those days. And it's crazy. And the whole reason why do you do that? Because they've always done it that way. You know, and then you've got bad handovers, etc., with that changing environment. So we're certainly seeing it across the board. At this stage, we're looking now at that pivot we talked about before. I've got rid of that polls. Stop sharing. We talked about before where we're looking back and what you should be looking forward for the last financial year with regards to your reporting. But the last 4 or 5 years, there's been a lot of work around and a lot of noise around ESG. Probably started off as sustainability. It's then sort of moved into a coverall called ESG. John, you're a massive advocate of this. You're sort of driving that business from a Grant Thornton perspective. Can you give us a sort of overview on what you're seeing and how it's going to affect organisations, and more specifically the people that are on this call?
Yeah, so look, completely agree that ESG is one of those terms now that is so commonly used that I think it's lost a lot of its original meaning. So just to take a step back, I mean, we see ESG as just an umbrella term that includes lots of factors that as accountants we think should be taken into account when you're looking at the whole value or performance of a business. So everything that sits outside of the financial report that a business does. So obviously the pillars of environmental, social, and governance themselves are umbrella terms for lots of other things. So we're really seeing climate change is often the initial driver for people to get interested. When they talk about ESG, that's often what people actually mean. And when it comes to reporting, climate change is the first area of sort of mandatory reporting that's coming. But there's a whole range of other frameworks that basically, as an organization, you have to work out what's important to you and what your people care about and what your material ESG issues are to be able to choose the right framework to report on. And so typically we're seeing that land with finance teams, which is why I think a lot of the people on this call will find it relevant. And that's because finance teams and accountants have the skills to handle lots of data and tell stories around that data and build systems and processes to manage the reporting.
Fair or unfair that it falls on finance teams?
Oh, I think that, like John said, finance teams have got the skills. I think ESG is such a broad term and a broad set of requirements that it's very hard to find a system that does ESG. We'll go on to that in a bit. There is no system, right? So we fall back to our old favorite, Excel. And I think you'll find that obviously if you're doing things in Excel, it will follow the accountants. And it's a very data heavy topic. You talk about emissions, scope 1, scope 2, scope 3, collating large volumes of data, putting them together, making sure they make sense. It's going to fall to finance.
Yeah, that makes sense. Safe pair of hands. Voluntary reporting, John, this is where we sort of move into, the key part of this webinar around reporting. Do you want to sort of give us a view of, what organisations should be looking at right now as part of their financial reporting process? Because you said that the ESG bit sits outside that normal financial reporting, but as we've just discussed, it's going to be actually dealt with by the same teams.
Yeah, so we'll talk in a second about mandatory reporting that is coming, but there's a piece before that for organizations that are interested or feeling the pressure to put an ESG report together, to do it in a proper way. So voluntary reporting is done by a lot of organizations already. There's lots of frameworks like the GRI, the Global Reporting Initiative, that I'll talk about in a second, that most Australian listed businesses already follow. So it's basically you step back, you work out what the key topics that your stakeholders care about are. So whether that's emissions, it could be diversity, it could be commitments to local communities. you choose your series of topics, and then under each of those topics, there's a whole range of prescriptive disclosures that you need to collect information on to build a report. And so the first step really is to do that analysis and work out what people care about. So we call that a materiality analysis, and that can take the form of a customer survey, employee surveys, interviews around the business. We've been engaged to help clients just with that process. So go and interview executives to work out what people care about. And I think you then, if you do that properly, you then come up with a report that hits the mark in terms of what people want to read about. If you don't do that, you run the risk of a report where you've picked issues that aren't actually that important to your stakeholders, or even worse, you can open yourself up to the risk of greenwashing that we'll come on to in a second. And so from a Grant Thornton perspective, we're obviously trying to help our clients with that, but we're also looking internally at our own ESG credentials and footprint to make sure we can walk the walk before we talk the talk. And I know, so the quadrant green lease, for example, is something that we're looking at in that area, because that would fall quite nicely into one of those GRI topics.
I think it sort of moves into that area where organisations now are starting to make organisational decisions that has some sort of ESG effect. So that comes into that decision-making process. I mean, John touched on the green lease, which we're talking to GT about at the moment. What is it?
Well, it's probably actually important to just step back a bit for the green lease was how it came about. And it came about very much where John talked about, where we talked to our staff and how we could make a difference in that ESG space. So obviously you can kind of look at, I don't know, offices powered by solar power, LED lighting, all of that, but it's such a minuscule kind of impact for a company of 30 odd people. So one of the things that was important to our staff was kind of, I guess, their community, and also there was a recognition that with leasing that it can help waste. So the green lease is very much a leasing product, so an operating lease product for IT, but it's a full life cycle product. So by that, what it does is you can still procure whatever IT equipment you want for your business, which is fit for purpose, but then we look after it for the life cycle. So we basically give you the reporting, the like. When it gets to your end of life, it gets wiped, cleaned. If it's not fit for purpose, it is e-wasted responsibly. It's all certified. You get back ESG reporting under GRI standards, UN SDGs and the like. But what's really, I guess, important and fitting home for clients and staff is there's also the social piece. So of that equipment, 20% can be then put into charitable initiatives, both in Australia and New Zealand, to help digital inequality. So give kids access to the internet and computers that are the most disadvantaged. And unfortunately, in both New Zealand and Australia, it's quite a big number. I think it's 120,000 kids in New Zealand of a population of 5 million. So by doing that and getting corporates on board, it still fits all your kind of commercial goals and all that, but you're suddenly getting that ESG bit, and that you've got the governance around the tools for reporting, you've got the E and the reduction in waste, and the S in the part of helping these disadvantaged communities. So again, it's something that's relatively easy to enable, but can actually make a reasonable difference.
On that internal review that we did within Quadrant, where does the decision not to give most team members Coro Club access fit in on that? It's a question from here. Before we go on, obviously, John, we talked about the alphabet soup part of things. Do you want to just talk about this next slide? Because it started to distill down a lot more, which obviously helps everyone in knowing where the hell do they start.
Yeah, and so the point of this slide wasn't to sort of scare everybody about how many reporting frameworks there are, but just key messages that in the past there have been a lot. So each of these logos is a different organization or framework that have been out there and adopted voluntarily for different reasons. So GRI, we've mentioned, for example, is a really broad set of standards that covers not just climate and not just the financial impacts of climate change, but can be reported to a whole range of stakeholders about, commitment to improving gender equality, commitment to local communities, whatever the topic is. On the other side, the TCFD is another sort of widely known framework around climate change. So particularly on the financial impact of climate change, there's a series of sort of recommended disclosures that basically the ISSB, which is a new board, a new accounting standards board that sits, a new international sustainability standards board that sits alongside the International Accounting Standards Board, to sort of give you an idea of the level of importance that we think they should be given. They're kind of as important as accounting standards. The ISSB has really brought all of that together, incorporated the TCFD recommendations into its first couple of standards, and those other organizations below it are actually part of the ISSB now. So within those standards, there's some guidance that for example, the SASB, which was another standards board that has industry specific guidance, has been folded into. So key message is really that they're starting to converge. All of these frameworks are starting to come together. There's some overlap, which is being eliminated. And the ISSB has issued a couple of standards that are actually going to be the first mandatory non-financial reporting standards internationally. So they're being adopted sort of country by country. New Zealand already has, and we'll come on to the actual timelines and everything, but so New Zealand has TCFD aligned reporting from 1st of Jan 23. Australia is looking at those ISSB standards and looking to adopt them from 1 July next year. But really, so the ISSB was formed to bring all of that together at the COP26 conference at the end of 2021. And as I said, has released its first couple of standards. They are focused on climate. They are focused on the financial impact, so they're aimed at investors. But we do expect other standards in future to be based on other topics. So they're talking about a biodiversity standard coming next. And the actual mandatory reporting is only really effective for large listed organizations initially. But what's probably more relevant to some of the people on this call is, even if you're not directly caught by those requirements, if you have any large customers, they themselves will have to report on their supply chain. So there are things like scope 3 emissions that your supplies to them will fall under. So you'll probably be asked for this information from those customers anyway, particularly around emissions.
Yeah, we talk about that last bit there on who is captured, because as you say, large organisations in Australia and New Zealand in the first instance, and we've got a number of those, today who have registered, but also that flow down effect. Stefan, how's that going to work?
Well, I think to John's point, scope 3 emissions is probably the most obvious one. We see with these changes, and especially with the ISSB mandating it for large listed entities, what invariably happens is those large entities will do this properly, but then it will trickle down through all parts of the business because other suppliers and the like will need to do it. It's also great that the ISSB has kind of been formed, because to John's earlier point, it was really hard to understand where to go. New Zealand took a leap of faith, and we're going to be the first up with our own mandatory reporting. There's some, I guess, a bit of dismay at that in some ways, that we're doing it first and how do we do it. And I think in some recent surveys, it's pretty clear people aren't completely au fait with what they need to do. But until you get started, you don't know. There's lots of guidance out there, but it's about collecting that data and getting it right now. And I think we'll see as it trickles down from the bigger, larger corporates, it's going to affect every area of business.
We just get back to that measurement and reporting piece, isn't it? It's just a theme that's really come through in the last 12 months around everything, just putting some rigidity there for it. I mean, basically how this is all going to be summed up, as well as providing some sort of forward-thinking reporting and that, there's also some areas you want to avoid. And we've seen a bit of a crackdown on this, JA, in the last year, certainly in Australia by ASIC. Greenwashing, it's been talked about. I like some of the little quotes there that you provided. Be less radiation waste than any of our competitors and stuff like that. Where did it come from? There was a great little anecdote about the actual phrase greenwashing.
Interesting. Yeah, the origin of the term greenwashing was actually, I think back in the 80s, there was an environmentalist, Jay Westerveld, who's a US environmentalist, and he was on holiday in a resort. I think it was in Fiji, and it was a luxury resort where they had in the bathrooms, there's little signs that say, if you don't want the towel washed, hang it back up and we'll save water. he thought that was great, but then he went outside and saw that the apartments next door were just washing the towels in the ocean and in the reef and sort of tipping the chemicals and everything out into the water right next door to those signs. So he came up with that term that, look, it's great that you're presenting the face of being environmentally friendly, but there's actually no substance to it, because behind it you're doing all the bad stuff anyway. So this term has really sort of come into its own, I guess, in the last couple of years around when we're talking about robustness and having some support for these sorts of statements. Like you can't just say we're carbon neutral or we're better than our competitors without something to back it up. And as you said, in Australia, ASIC are really concerned about it. So they've launched a number of high-profile litigation cases against companies for this. So cracking down on sort of spurious claims about green funds or funds being invested in green assets. There was the case the other day of they raised an action against a big fund because of a Facebook post. So not actually anything in the reporting. They just said something on Facebook like, these funds have been moved out of fossil fuels into something green, and there was no evidence to support that. So yeah, look, every client that I speak to is really worried, particularly directors who are sort of legally on the hook for a lot of what goes out there.
From a product perspective, getting back to the green lease we talked about before, what's the differentiator between something that's greenish and then something that's, measurable, actionable, verifiable, etc., etc.?
Well, I guess it's a difficult one to quantify, so I can probably only talk to our own experience in setting up the green lease. I think what we were careful to do was to make sure that everything is verifiable and measurable. So the process and the standards that apply, the measurement, all of that is independently assured. So we actually go through a process where a firm independently assures that, so that clients know what we're saying we're actually doing. Also, we've really much stuck to the facts and figures that can be verified. So a really common green claim at the moment is with carbon offsets. And everyone would have been reading the paper recently about a lot of these carbon offsets are not really achieving what they are supposed to be achieving. So saying something's green because you paid someone to plant some trees somewhere is going to start to become a problem. So what we did was we made sure that the process around e-waste reduction and the like was very much verifiable, was ISO certified. We had the whole process assured. So that whole thing works. And again, all your partners within that value chain are all signing up to the same thing. So it's not so much the individual activities, it's the sum of the parts and making sure that that can kind of be verified. And I think that's also why ESG has been so difficult, because without a standardized framework, you can say it's kind of quite green under GRI, but it might be quite different under TCFD. So I personally, and we had a chat with one of the sustainability networks in Australia last week, that ISSB should really help pull things together and get action a lot faster than what we've seen to date.
Yeah, well, it's quite important, especially if you've got the regulatory bodies and that looking at it. So greenwashing, another cool thing that's come out of the 80s, that word, like leather jackets and mullets. Thanks, gents, for your time today. I mean, if we're looking at the key things that we wanted to cover in this webinar, and hopefully we have for those of you who have joined, we've got a rapidly changing environment. Auditors are looking really closely at a couple of key things. And like we said, it's around those policies, it's around automation, etc. They're getting a bit harder. There's probably a few, to say free passes will get me in lots of trouble, but with COVID, etc. But now, especially in IFRS 16, they're really starting to hone in on some of the key aspects and complexities. For a pretty vanilla product such as leasing, there's some real complexities in there that have been under the spotlight. That then flows on to having the right processes, having the right reporting, etc., which then goes on to this ESG part, which is, I think we all agree, really, really important. And it's a huge step to having that mandated reporting going forward. Now, before we finish up, we've got a few questions. So I will go to the questions. The slides after this will be distributed. Marty, Jay will be sending out both a copy of the webinar and also the slides. Someone's asked, will audit raise an issue if no automated leasing system is maintained? If so, under what circumstances? John?
I think that I would expect at least a recommendation to be raised. So an auditor usually issues a management letter at the end of the audit to say, look, even if we didn't find any material errors, here's a list of recommended improvements. We'd like to come back next year and see that some of these have been addressed. So I think at the very least, it would probably be reported in something like that.
What about you, Stefan? What are you seeing on the practical side?
Yeah, I guess what we're seeing from our clients is it's probably a materiality thing. So if you've got 5 leases, yeah, you can definitely do it in spreadsheets, especially if it's 5 cars. Once you start getting in the double digits and you get big properties and the like, it's just so much work for auditors to work out if a spreadsheet is truly working. So often an auditor's comments will also be to make the auditor's life easier as well. So I don't think there's a blanket yes or no, but it's probably definitely a sliding scale. As you get more leases and more materiality, that will start to become a problem.
Cool. Here's an interesting one. Shouldn't ESG fall under the remit of operational side of the business, not finance?
So it's for me. So I guess yes and no. So I would imagine that different parts of what you'd call the operational remit, say the fleet managers or the building managers, will ultimately be tasked with maybe obtaining that information, but I'm not sure that they'll have the skill set to kind of pull it together and produce the information that will ultimately be required, because it's just not in their remit, right? So they will definitely be involved. I mean, I guess ESG is everyone's problem, but I think it will ultimately come back to finance or dedicated sustainability departments.
Serve finance right for doing their jobs properly. Last one to you, JA. If an organisation signs a contract with a verified green company, can this be reported under ESG?
Look, I think it definitely can. It can definitely be sort of told as a story if you're signing contracts with green organizations. I think the important thing when it comes to reporting those is to talk about the impact of doing that. So everybody can put a report together that tells a really good story about all the great stuff we've done. So we've signed all these green contracts, we've given money to these initiatives, but the real challenge is, what was the effect of that? So did it actually change things in your business? Did it actually have an impact? Did that money you gave to an organization go somewhere else after that? And that's where the robustness comes in, is what process have you got to measure that and check that? So yes, it definitely can, but I'd caution that by itself, it's probably not a very robust story without some of the data behind it.
I mean, from a practical perspective and a real product perspective from the green lease, what if a client's got a green lease product and sign a contract with Quadrant for that, what can they report?
Well, I mean, what we've been careful to do is work out where it fits in the framework. So the waste reduction piece is very verifiable, because at the end of the day, we'd say X devices, X amounts of material were avoided from e-waste, and that's a very big problem in Australia and New Zealand. On the social stuff, it's a bit harder because you are giving laptops to disadvantaged kids, and it's kind of hard to give too many hard facts. Having said that, the guys are doing for I think it was one of the Southland schools, Massey's doing a study after the fact to see the impact of that. And I think those are the next steps, right? Changing the behaviours, finding out what actually works. Because I guess even like 3 or 4 years ago, a lot of the stuff that people were doing, it was just ineffective. So a real common one that we saw was, yeah, we're giving our laptops away to disadvantaged people. It's like, well, have you made sure that they're secure? Do they have instructions? Do they know how to use them? If you don't have that whole ecosystem, it doesn't work. Back to John's earlier point that it's not about just telling the story, it's been effective at it as well.
Yeah, I think that's where the focus is really going to start to intensify, isn't it, coming through, that these sorts of things are reportable, they are measurable, and you've got something to back them up, because you don't want to be gun shy. And we've already seen the regulatory boards penalise organisations for Facebook posts. So get off your Facebook feed. thanks to everyone. That has been really good. John Askham, thank you very much for your insights. Really important. As I said, John's remit at Grant Thornton is around advisory, but especially around that ESG space, which is growing massively. So anything that anyone wants, please reach out to him. Stefan, as always, thanks very much. And we'll see you for the rest of season 2, the webinar series from Quadrant in the not too distant future. Thanks
all. Bye.
Yeah, thanks, guys.